2025 appeared, on the surface, to be a successful year. Equity markets rose, headlines were optimistic, and most investors felt comfortable. But if you only watched the stock indices, you missed the real story. Because quietly, beneath the surface, an asset that had been ignored for decades began to reprice itself. And as we enter 2026, the question is not whether silver has already moved. The question is whether it has finally broken free from the pricing reality that constrained it for half a century. The year 2025 closed in a way that very few investors were prepared for. Equity markets delivered strong headline performance. The S&P rose roughly 16%. The Nasdaq gained close to 20%. But those numbers, impressive as they appear, were completely overshadowed by what happened in monetary metals. Gold advanced nearly 60% over the year. Silver rose approximately 140%. Those figures alone should have forced a reassessment of long-held assumptions. Yet surprisingly, many market participants remained hesitant, particularly when it came to silver. Even as prices surged, skepticism persisted. Each rally was questioned. Each pullback was treated as proof that the move had gone too far. Ironically, the investors who performed the worst were not those who lacked information. They were the ones who consistently doubted the move. They sold into strength. They hesitated on weakness. Meanwhile, the investors who simply accumulated silver during every 10 to 15% correction quietly outperformed nearly everyone else. This behavioral divide explains much of what unfolded in 2025. Looking back to late September, gold was trading near 3,700 while silver sat around 42. By January 1st, gold had moved to roughly 4,300 and silver reached levels near 70, briefly touching 80. These were not random price fluctuations. They reflected a structural shift that had been building for years. As we move into 2026, the critical question is not whether silver has moved too far too fast. The real question is whether silver has finally exited a pricing reality that constrained it for half a century. Silver is not behaving like it used to. This is not a normal bull market. Traditional technical tools such as overbought indicators and short-term oscillators are increasingly irrelevant. Silver is no longer advancing in measured layers. It is in acceleration mode. It is in what can best be described as a new reality phase. The most important signal confirming this shift does not come from silver alone. It comes from silver relative to gold. For much of the past year, the silver to gold relationship sat near historic extremes. At one point, silver represented roughly 1% of gold on a relative basis. Historically, whenever this ratio fell to such depressed levels, silver eventually responded with explosive upside moves. There are clear historical precedents. Between 1979 and 1980, silver rose from just a few dollars to nearly 50. Much of that gain occurred in the final quarters of the move. Prices compressed upward rapidly. A similar pattern occurred between 2010 and 2011. Silver doubled and then surged again within a very short time window. In both cases, silver did not move gradually. It repriced itself violently. What makes the current situation different is the duration of suppression. Silver spent nearly 50 years trapped inside an artificial range. Other commodities did not suffer this fate. Copper broke out of its multi-decade range in the mid-2000s. It quadrupled within a few quarters. Lead did the same in 2007. It moved into an entirely new pricing regime. Silver did not follow those moves. It stayed boxed in. When markets remain mispriced for too long, they tend to overcorrect once the constraint is removed. They do not gently adjust. They compensate aggressively. By mid-2025, momentum indicators were already signaling abnormal behavior. When silver approached the mid-30s again after multiple failed attempts, the character of the move changed. Resistance no longer held. Prices accelerated through levels that had capped silver repeatedly in the past. By November, the silver-to-gold ratio finally broke out. That massive basing structure had persisted for years. That breakout marked a regime change. Once relative performance shifts, absolute prices follow. This brings us to the broader monetary backdrop. In January 2020, US M2 money supply stood near $15 trillion. Today, it exceeds $22.4 trillion. That is an increase of roughly 42% in just 5 years. The purchasing power of currency has been deeply eroded. When silver traded at 50 in 1980, adjusted for today, that equates to roughly 190 to 200. When silver reached 50 again in 2010-2011, that corresponds to approximately 75 today. By that measure, silver is only now approaching prior real peaks. History shows markets rarely stop at fair value during repricing events. They overshoot. On a relative basis, silver has spent roughly 20 of the past 50 years above 2% of gold. During major bull markets, that ratio extended much higher. It exceeded 6% in the late 1970s. It exceeded 3% in 2011. Today, silver remains near 1.6% of gold. If silver merely returns to prior relationships, implications become extreme. A move toward 200 within 6 months may sound implausible. It is not unprecedented in compression cycles. The industrial backdrop only strengthens this case. Silver demand continues expanding through solar, electrification, data centers, and electronics. These applications are not optional. Silver is embedded in critical infrastructure. Meanwhile, supply growth remains constrained. New mine development is slow. Grades are declining. Recycling offers only marginal relief. At the same time, silver's monetary role is reasserting itself. It is increasingly viewed as money rather than just a commodity. When investors think in ounces instead of dollars, confidence in currency is already fading. This shift coincides with sovereign debt stress. The United States runs deficits exceeding $1.8 trillion annually. Long-dated bonds have failed repeatedly to stabilize. Similar pressures exist in Japan, Europe, and the United Kingdom. If yields resume rising, confidence in government debt weakens. That is not localized. It is systemic. Equity markets show signs of exhaustion as well. Leadership has narrowed. AI-driven stocks surged late in the cycle, echoing 1999. Historically, such leadership precedes weakness. Bitcoin has already begun breaking down structurally. After peaking near 125, it fell below long-term support. Consolidation may occur between 80 and 90. The broader structure suggests a move toward 60. Unlike past cycles, Bitcoin is now intertwined with the financial system. ETFs and institutions increase contagion risk. In contrast, monetary metals are breaking out relative to stocks. Gold versus the S&P exited an 11-year range. Gold miners followed. Silver followed as well. These are not short-term signals. They represent asset class rotation. Commodities broadly are beginning to move. The Bloomberg Commodity Index remains near 110. That is far below peaks near 237 in 2008 and 170 in 2011. Historically, commodities perform during monetary stress. Oil remains suppressed near 60. Structurally, it is cheap relative to equities and gold. When oil moves, it rarely does so gradually. A $10 to $20 move would not be unusual. Political stability adds further uncertainty. Rising debt and policy improvisation undermine confidence. Markets respond to that erosion early. This is why silver matters. Silver is no longer waiting for permission. It is already repricing. Skepticism remains widespread. That is typical early in secular shifts. The most dangerous assumption is that the old framework still applies. It does not. 2025 was likely not the climax. It was the prelude. Silver spent decades clearing its throat. 2026 will reveal how loud the message truly is.
Hello my dear friend, welcome back to my channel and my today new video. So friend, 2025 appeared on the surface to be a successful year. Equity markets rose handily as we are optimized and most investors left comfortable. But if you only watches the stock and unless you missed the real story because quality beneath have surfaced any asset that had been ignored for decades begin to reprise itself, and as we enter 2026 the question is not whether silver has already moved. The question is whether is it has finally broken free from the pricing reality that consistent it for half a country. The year 2025 closed in a way that very few investors were prepared to, for equity markets delivered strong headlines performance. The SEP rose regularly 16%, they gained close to 20%. But those numbers impressive as the paper appear were completely consumed by what happened in monetary related gold. It was nearly 60% never in the year. Thank you so much.